Reserve meets today, and the expectation is that they will announce the first interest rate cut since December. This has been a hot topic for a while now. The announcement will come at the end of the Fed's two-day policy meeting in effort to support America's slowing labor market. That's another report that came out that frightened a lot of professionals in this space. So financial advisor Christian Clausen from Burns Financial joins us now to break down this decision. So this was imminent. You knew the conversation was going on.
Yes.
Christian, do you think that they waited too late?
Yeah, there is a possibility they did. They have a really tough job because they have two mandates. One, make sure unemployment is low, as well as keep inflation low. They've been really focusing on inflation, and I would say they've done a good job of that. Inflation right now at about 2.9%. But what we've seen lately is that the unemployment rate has started to go up, starting to get weakened. And that's something that they're concerned about, and that's why I think they're going to take action today.
So the idea is if you lower the interest rates now, what impact will that have on the job market?
We're hoping that the businesses now, they can borrow money cheaper, they can expand, they can grow. Usually we see that happening. Right. So if they're growing, they're going to need more, employees, and so they may start hiring again.
Okay. And how long do you think we'll see that impact of a lower interest rate? How long is that going to take?
It's a pretty slow move, so when they do that, it takes, 3 to 6 to 9 months to really see the effect of it. Mm-hmm. Last time they did this was like last year around this time. They started the interest rate cuts by 0.25%. Mm-hmm. I think that's what they're going to do again. And then we'll see. The expectation is they're going to have 2 more interest rate cuts this year, but we'll see.
Okay, so by cutting that, though, if you're someone who's preparing for retirement, you're close to it, you're in it, mm-hmm. It also cuts the value of your CDs, it cuts the value, talk about that. Yeah,
we have to think about, like, safe investments get hurt when interest rate gets lower. You're not going to get the same rate on your CDs. If they cut it 0.25%, that typically trickles straight into, like, now you get lower rate CDs, lower rate bonds, savings mm-hmm. rates are all going down.
Yep.
On the other side, it's typically good for the stock market as long as inflation stays down. So as long as you have a good allocation in part of your investment, both stocks and safety, you should be fine.
So call your finance person and look at your cash flow today.
Absolutely. Make sure. Yeah.
Talk about, we touched on this in the commercial break. If this does not work and inflation continues to rise, we could be in the same situation in 2022 that we were in back then. Why is that?
Well, the other side, so market loves that interest rates are being cut, but they hate that inflation is going up. And so we look at 2022, that's exactly what happened, right? Mm-hmm. Inflation just went down. Of course, this was because of COVID. It was like a lot of other factors.
Right.
But you think about unemployment, that affects a certain amount of people. But inflation affects everybody. Mm-hmm. And so that's why it's really hard for Fed, it's a balancing act. Okay. And it's been like that for years.
All right. We have a lot to watch, but we know that we can count on you to walk us all through it.
Absolutely.
Christian Clausen, thank you so much.
Thank you.
All right. Let's send it over to meteorologist Zach for